where I'm going to just quickly summarize what the Fed has done. So this is their big monetary policy announcement, and they didn't change the rate this time. That's exactly what markets were expecting. It's very unusual for them to do something which markets weren't expecting. But I think what's interesting is the reasons behind what they did, and also some of the questions at the press conference were kind of interesting, so I'll go through those as well. Now, the actual decision itself, I should also say at the end of this you can ask questions, so that's usually the biggest part of this session. It's funny, Michael Pugh, my co-host on the podcast, Many Happy Returns, he always jokes that I can talk for 45 minutes about the Fed doing nothing or the Bank of England doing nothing, which is true, but usually the summary is much shorter, and then we have the questions which last a long time and aren't always to do with monetary policy. So I'll summarise, then we'll have questions at the end. So obviously it was a unanimous vote this time around, so no dissent from the voting members. That's often the case with the Fed. There aren't usually too many dissenters. So the rate is staying between 4.25% and 4.5%. That's the federal funds rate. The process of quantitative tightening, which is the way they used to have $9 trillion of US debt, both government debt and agency debt. This is mortgage-backed securities on their balance sheet at the Fed, and that was to stimulate the economy. That's been shrinking for some time now. It's come down by about 2 trillion since its peak, and that process has slowed down a tiny bit. So in March they announced a slowdown, and that's been carrying on. And they've noted that there were huge swings in the data which actually make it difficult to have a good read on the economy. A lot of companies were bringing forward their imports ahead of the tariffs. And because of the timing of the data that comes in, that caused a distortion in GDP. We got a negative GDP print, but a large proportion of that was due to this bringing forward of imports. So that makes it difficult to see what's going on. But let me just read from the Fed statement. Swings in net exports have affected the data. Recent indicators suggest that economic activities continue to expand at a solid pace. So when you strip out that distortion from imports, things still look okay, which is really good news for the US economy. The unemployment rate stabilised at low levels in recent months. Labour market conditions remain solid. So all this stuff about soft data falling off a cliff, well, the hard data, which of course is what the Fed looks at, still looks pretty solid. So the Fed's in a difficult situation, I think, where they think that what the conditions are going to get worse, but they can't act until they actually see it in the hard data. So they say inflation remains somewhat elevated, but uncertainty about the economic outlook has increased further. And the increased further were the two words they added this time around. Last time it was just uncertain. So it's even more uncertain than it was at the last meeting. And they also judge that the risk of higher unemployment and higher inflation have risen. Now, of course, the Fed's dual mandate is full employment and stable prices, inflation at 2%. And those two mandates might be in a position now where they're in tension, because if we've got weakening growth, if that actually happens, at the same time as higher inflation due to the tariffs, well, the higher inflation would make them raise interest rates. The higher unemployment would make them cut interest rates. So that's the tension that Powell repeatedly harked back to during the press conference and the questions. So that's a very difficult position for a central bank, because it's not clear which way they should act. And so their conclusion was that they should do nothing, that they should just wait until there's more clarity in the data, until a path does become clear, and then at that point they should act. And he kept on saying they're in a very good place, with their policy right now. So that's a pretty high interest rate and a pretty restrictive policy rate, given that inflation is not far from the 2% target. So I'm not sure that is a good place, but still, that was their characterization of it. Dual mandate, yeah, that came up a lot. But overall, the economy looks pretty good. The policy rate is restrictive, but it's 100 basis points below where it was last summer. So less restrictive, but still restrictive. There were questions about presidential pressure. Moving on to the press conference, how does President Trump calling on the Federal Reserve to make rate cuts affect your decision today? And does it affect your job? Is it difficult? And Powell replied, it doesn't affect doing our job at all. So we're always going to do the same thing, use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it doesn't really affect our job or the way we do it. So very clear that they're not going to give in to pressure from the president or any other source. They are independent. So I think a lot of people are looking at the Fed right now and thinking, okay, Powell's going to be there for another year. In May of 2026, he's going to be replaced by a nominee from President Trump. Powell was nominated by Trump previously as well, of course. But the question is, will that person be someone who will just cave in to pressure from President Trump? Or, more subtly, perhaps there'll be an agreement before they get the job that they'll be more likely to lower interest rates than raise them. So that will be the big worry, and the kind of indirect lack of independence that could occur if such an agreement takes place, or if President Trump has screened that Fed chair, to be someone who is more dovish, who is more likely to keep rates low. So that's quite likely, I'd say, unfortunately, but that's the real problem that markets are facing. And every time that Trump says something about firing Powell, recently over the last couple of days, he said again that he wouldn't. But every time he did say it, then markets sold off. Markets hate the idea that the Fed will not be independent, that the president can dictate interest rates, because that's really veering into kind of third world territory. So I think that's why markets hate it, because it's not in the interest of markets, it's not in the interest of the economy not to have an independent central bank. There was a bit of a joke. So there was a laugh when they were talking about giving Congress fiscal advice. So Congress, government, decides how to spend tax money. That's their job. The central bank decides monetary policy. They decide interest rates. And Powell said, we don't give Congress fiscal advice. We take what they do as a given. We put it into our models and in our assessment of the economy. I wouldn't want to speculate on what they're going to do. He did say that the debt is on an unsustainable path, and it's up to Congress to figure out how to get us back onto a sustainable path, but it's not up to us to give them advice. And then the kind of follow-up question from the journalist was, should Congress take macroeconomic conditions into account as they look at this? And he said, I don't think they need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy. And that got a laugh. So don't tell us our job and we won't tell you your job. There was mention of the US-China trade talks in Geneva. That was Claire Jones of the FT. And he said that they weren't involved in the meetings, so they can't comment on it. But the size of the tariffs was substantially larger than anticipated in their forecast before it was announced. So this is why they think that there's now a higher risk of higher unemployment and also higher inflation. So he says it's going to be very important how it shakes out, the meeting between China and the US, but we'll have to just wait and see. But it could change the picture. We're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing. So really, the Fed is no more informed than we are about what Trump's policies are going to be when it comes to trade. They're just sitting there trying to look at the hard data and make sense of it. They can't really preempt what markets will do or what the president is going to do. They just have to react to it. So that was my kind of summary of it, as of the meeting today. So I do have, let me just skip through some of these data points because I think they are interesting. This is what the market expects. So let me just scoot over here. Yeah. So this is, I always take a snapshot every morning just before the policy announcement to see what is priced into the futures markets for Fed funds futures. Now what this tells you, each of these rows is one meeting and the date of the meeting. So today's meeting was May the 7th and the next one's going to be June the 18th and so on until we get to the end of this year, and then 2026 starts here. What this tells you is currently we're at between 425 and 450 basis points. That's the current Fed funds rate. And there was 98% probability that the Fed would keep it where it is. There's also 72% probability that they won't move in June. I think that's pretty spot on. Because let's face it, the uncertainty is unlikely to go away. But then the first cut is going to happen in July. Then there'll be another cut in the next meeting, so 0.5% below where we are today. And then by the end of the year, we're going to be about 0.75% percentage points below where we are today for Fed funds. And then a couple more cuts priced in later. So not a huge set of cuts, given that we're pretty close to the inflation mandate right now. So I think it's fair to say that markets are actually pricing in higher inflation now. Because of tariffs. And here's the balance sheet runoff that I talked about. You can see that it's falling, although I don't know if you can tell, but it's falling a little bit less quickly than it was. This slope has flattened out a little bit because they're easing off on the quantitative tightening. And we didn't have a summary of economic projections this time. That's what they gave us last time. We will get a summary of economic projections, the dot plots, again in the next meeting, which is next month in June. So yeah, it'll be interesting to see what they come up with. So that's, yeah, let me just quickly show you that GDP number as well. So this is the GDP number falling. That was the latest print, but it was distorted by those import data. And if we look at inflation itself, you can see that it isn't too far off the Fed's target. Now, they don't actually look at consumer price inflation. They look at personal consumption expenditures inflation. But again, that's kind of the core version is what they focus on, although they look at everything. And you can see that it's not too far above their 2% target. But it's been stuck here for quite a while now. It's been almost, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about almost a year stuck in this band, which is above their target. So sticky, it looks like, and wage growth was pretty good. The labour market was very strong. So that's probably what was keeping core PCE higher. But of course, now what we're going to see is the shock from the tariffs, and that's going to have to work through the system. So that's going to take another year at least until that drops out of the comparison window. So that's going to distort things. And once we have a huge bringing forward of imports, we'll see the data swing the other way, of course, where imports will slow down a lot. So that'll distort the data the other way. I think that's about it. Yeah, the labour market's not as tight as it was. Non-farm payrolls has been pretty strong. 177,000 jobs added last month, 185 the one before. So still pretty good job growth in the United States, and overall a pretty strong economy. So really everyone's just kind of waiting and seeing what's going to happen with the hard data. Right, so at this point, having summarised stuff, I shall summon my dog to give you a chance to think of a question. And I shall give him a treat, delicious beef treats rather than the stinky ones I used to have, kept in a pistachio jar. and then he'll go downstairs for biltong. That's the plan. That's what he's done. That's what he's trained us to do. So a couple of treats from Dad upstairs, downstairs for biltong from Mum, Laura, afterwards. Oh, hello. You gonna have a treat? Yes. Good boy. Yes, today I managed to sneak his worming tablet into a Frankfurter. He doesn't know that. He doesn't know that. I felt really clever after that. Yeah, you ate it so fast, didn't you, the Frankfurter? You didn't even taste the tablet. Good boy. You going to go downstairs for biltong? Yeah, come on. Laura's going to rattle the box. Can you hear it? Now let me open the document that Laura gives me, which will remind me what I've forgotten to say. Yes, I should say also that the Bank of England announces its policy rate tomorrow, so we'll be doing this all over again, and we'll be live at a much earlier 6 o'clock. Thank you, Bank of England. Of course, they announce it early in the afternoon, but we just don't think people would be around for a live stream. So we do that at 6. And we get a monetary policy report as well, so lots of stuff to digest for Romin before the live stream in the evening. Right, back to your questions. So please do Super Chat, we'd appreciate it. Obviously, it's revenue for us, and we'll push you to the front of the queue. We'd appreciate if you did that. Or if you're one of our supporters on YouTube, also we'll push you to the front of the queue. Try to hold off as we get to the end of this session. Don't ask a question at the end, because we end up carrying it over to the next one, which isn't very satisfactory for anyone. Right, so the first one, actually we've already got a Super Chat, thank you. I should also mention our podcast, Many Happy Returns. Now, you can listen to it on YouTube. Let me switch to that so you can see that. So Many Happy Returns is what it's called. And the latest episode was about... This episode is brought to you by Buffett. Warren Buffett retiring. And Buffett bows out. Can Berkshire thrive without him? So that was the purpose of... That was the topic of our podcast this week. We couldn't really not talk about it. I mean, the guy's a legend, and 60 years in the job. It's incredible. And what was interesting was that Michael had quite a different opinion about the reasons for his success than I did. I was quite surprised. So do have a listen to that to see, our kind of difference of opinion. Brilliant. So your questions. First one is a super chat. Thank you. And this is from Lenin Velaturi. Thank you, Lenin, who says, Acqui versus PACW. What's your take? Okay. Let me pull up our cheapest funds spreadsheet just so you can see what we're talking about. And it's got a nice link to stuff so we can dig into it. Right, let me maximize that. Webcam, very good. There we go. So if you're a member of our website, if you're one of our premium website members, you get access to this cheapest funds list. So if we filter by UK funds, now we've got Europe, notice. So if you're a European investor, we've also got the cheapest funds for Europe, thanks to Hannah, our intern, who's been working with us. And we've also got a wide variety of different types of fund now. So we've got high yield, ultra short bonds, US stocks and so on. But let's look at global equity, because that's what you were talking about. Let me move my face a little bit further up there. And the two funds you mentioned were PACW, so that's the first ticker. So that's the Amundi Prime All Country World UCITS ETF. That's an income fund, not an accumulation fund. A lot of people I know like accumulation because you don't get little dribs and drabs of cash into your account, which you then have to reinvest. They prefer accumulation where it's reinvested for you and the income becomes capital gain, which is what this fund is, which is the State Street SPIDER, MSCI All Country World Index, UCITS ETF. Now those two are very similar in the sense that their fees are very low. Amundi's tried to undercut every other fund provider, so its ETF has a fee of 0.07, which is getting to the kind of levels that you see in the US, which is great. So thank you Amundi for that. And it's interesting that State Street cut the fee on their fund massively. I think it was about close to 0.3 percentage points, but now it's 0.12, and it's very competitive and very large, it has to be said. But which one would I prefer? I don't think I'd really care which one it was. I mean, income is annoying, so for the sake of 0.05, 5 basis points, 0.05% difference in fee, is it worth having to reinvest the dividends? It depends. I mean, on some platforms like Trading 212, you can create your own accumulation fund by just having a pie with one fund in it, which is set for reinvestment. Then the day that the dividend is paid, it's bought, it's used to buy more of the fund. So effectively, you're creating your own accumulation fund, and it's all automatic. It's very easy. So yeah, I mean, if that's the case, if you're on a platform where you can do that, so much the better. But would I choose one of these over the other? Probably not. They'll be very similar. So if we compare them side by side, we just pull up the two funds. So let's get I wonder if it's got has it got the stuff that's in it? Monthly fact sheet, that'll be helpful, won't it? Holdings, there we go. So these are the top 10 holdings. So now let's compare that with the other one. See if I can pull that out here. Where is it? Yeah, so let's pull out the Acqui one as well. State Street's site is very good as well, so that's got some nice descriptions of the fund. So I wonder if we can do these side by side. Okay, there we go. So here are those two side by side, just so you can compare the actual holdings for the top 10. And the point I'm trying to make here is that they're very similar. So top holding, Microsoft Corporation 3.93, Microsoft Corporation 4.12, Apple 3.8, Apple 3.9, Nvidia 3.6, Nvidia 3.5. You see my point. For the top 10, which completely dominate the holdings, you can see that the holdings are actually very similar. They're the same stocks with very similar weights. And that would be true if you go down the whole table. So I think if it is an all-country tracker, like both of these are, there's only one world you can buy. So the returns will be similar, and all that really matters are things like domicile, because that can affect the withholding tax. That can certainly be an effect. That can certainly affect the returns. And if we find the ISIN code for this, we could probably figure out where it's domiciled. I'm guessing, from memory, it's in. Yeah. So this one's in Ireland, which has a very beneficial withholding tax of just 15%. So 15% of the dividends are withheld in the US based on the Irish domicile of this fund. And I suspect this one also, if we find the ISIN code, yeah, also in Ireland. You can tell because it starts IE, the ISIN code. So yeah, both of them will be good from that point of view. So, I'd be pretty indifferent between the two. The domicile is the same, so the withholding tax will be the same. If there was a synthetic version of these, it would be quite cool, because then it would be beneficial, because you wouldn't pay any withholding tax at all. But both of them are physically replicated, I think. So direct physical for this one, so the Amundi one, And I think there is actually an accumulation version of this one, but yeah, this one's a distributing one. I wonder if I can find it. Here we go. Yeah, WebN is an accumulation fund, and everything else about it is the same as the income version, but I think on a lot of platforms in the UK this one's not available yet. At least last time I checked with the community, they said that it was an issue. Now, when was this thing? What was the inception date of this thing? Inception. That's the birthday for a fund. I don't think I've got it there. Inception date. Well, we can tell from the price data. So what is it? WebN. Let's bring up the time series. So let's look for WebN. Yeah, so it's only been around since October of 2024. And let me remove some of the other stuff, just so it's clear what we've got. Yeah, so all we've got here is, I've compared it with the MSCI All Country World Index, and you can see the two are very similar, as would any pair of global equity funds be. So, yeah, very similar, those two funds. So, yeah, I'd be pretty indifferent between the two. I'm not really, don't really feel strongly one way or the other. And if there was an accumulation version of the Amundi one on my platform, I may well go for that. And I'm not sure whether Invest Engine's got that, but now that my SIP is on Invest Engine, I may well go for the cheapest one, which is the Amundi one, and move out of Acqui. Anyway, back to your questions. And the first one, the second one is also a super chat. Thank you very much. Keep them coming. This is Josh R. And they say, what are the risks, if any, of an ultra short bond fund such as EARNS? So again, back to the cheapest funds list. And so if we switch category to ultra short bond, so these are the two we've got. You can see that EARNS is the iShares Sterling Ultra Short Bond UCITS ETF. So let's have a look at that one. And iShares is great. You know, the description of their funds is just astonishingly good. And let's look at the holdings. So what you kind of expect from ultra short bond ETF, a lot of commercial paper, stuff with very short maturities. So if we look at the average maturity of the stuff in it, 70% of it has a maturity date less than 1 year. So very short dated. 20% is 1 to 2 years and 10% 2 to 3. So the overall, let's find what the modified duration is. We'll just look for the duration of, okay, so effective duration 0.3 years. So almost no interest rate sensitivity, just a tiny multiplier. So if yield curves increase by 1%, this fund will only lose 0.3%. So very small duration and very small volatility. So if we plot its value over time, you can see that it's very smooth. Now this is the distributing version, so it will have a kind of rampy shape. Let's have a look at the rampy shape. And I'll remove, actually let's not remove. So you can see the shape of this fund, that's the black line, so that's the money market fund, and you can see global equity in the blue line. So that's the price you pay for a money market fund or a money market type fund, which has very short duration and it's very safe. So let's take that away, just so you can see the ramp shape as each coupon is paid. So you can see this, the size of these ramps varies with the income. The idea with the money market fund is it's always worth £1 or £100 or a fixed price, and it pays you out some kind of income on a regular schedule. So the schedule for this one, if we look at the dividends, is what is it? It seems to be every 6 months. So it pays out every 6 months. So that's the coupon frequency, if you like, and you can see that recently it's been increasing as interest rates have increased at the short end of the curve. So that's what it looks like. It's got this rampy shape. What are the risks with it? Well, as with any investment, there's a risk of the stuff it invests in. We saw it's got quite a bit of commercial paper. That's a market that could freeze up in a huge crisis. That has happened in the past. It happened when Lehman went bust. They were a big player in the commercial paper market. They were also a big issuer of commercial paper themselves. These are really short-term IOUs issued by companies, which most of the time are very safe, but they do go through these liquidity crises. So that's one risk. There's obviously a risk that the issuer itself could go bust, but that wouldn't be an existential problem for you. You wouldn't lose money because you own the stuff in the fund. You're the effective owner of a slice of that fund. The fund manager would just sell the fund, it would be liquidated, and you just get your money back. And the value of the fund would just depend on what it owns, not on the guarantor of the fund, if you like. So I think those are the risks. But in terms of interest rate risk, credit risk, those are all fairly low. So if we look at the holdings again, and if we look at the credit quality, you can see that the vast majority of the paper in this fund is AAA, the highest credit quality, where a default is exceptionally unlikely. It does happen, but it's very unlikely. With a bit of it AA, tiny bit of some single A, and a tiny sliver of triple B, which is just not one notch above junk. Interestingly, there is some that's been downgraded, so that's 0.25% of the total holdings. So they'll be selling that paper now that it's not high credit quality, I assume. But those credit ratings will change over time slightly, but that's pretty high credit quality. So yeah, I think the risks of this thing, very little credit risk, very little duration risk, so it's not sensitive to interest rates. The big risk, I guess, is that the Bank of England cuts interest rates, which it's going to do tomorrow, markets think. And of course, in the UK, we've got weak growth, we've got inflation still above the target, but not too much above the target. So it's very likely that the mandate for the Bank of England will be pushing it towards cutting. There are some hawkish members of the Bank of England's Monetary Policy Committee, but they're pretty thin on the ground. I think Megan Green is, and a couple of others. But I think it's likely that the bank will cut tomorrow. So that's the risk, that the rates aren't fixed and they get lower over time as inflation comes under control. And of course, we don't have tariffs in the UK, or we haven't whacked up our tariffs in the UK hugely. So for us, we haven't got the same inflationary problem as the US. And it was interesting, I saw an interview with Megan Green herself, and she's on the MPC, and she was saying it's more likely that this will be disinflationary because countries which can't export to the US, like China, will be exporting more heavily and cutting prices for the stuff they send to us. So that's disinflationary, the effect of the trade war for the UK, which is kind of interesting. So big risks, I don't really think there are any. I think people don't understand that rampy shape and the fact that it's always a constant price except for the ramp. That's confusing. I think accumulation version of money market funds are much more interesting, much more comprehensible. Strictly speaking, it's not a money market fund, that one, but it is just a ultra short duration bond fund, but the returns will be very similar to a money market fund. Anyway, that's my take on it. Not many risks at all. By design, of course. And also not much return, of course. Brilliant. So back to your questions. How are we doing for time? And we won't go for long because we're very tired. It's quite late in the UK. I'm sure you're tired as well. So let's just do a couple of questions and then we'll finish. What do you think will happen if China refuses to talk to Trump? That's Dr. Scopey. It was actually mentioned as one of the questions. It was Claire Jones talking about the talks in Geneva. It was funny because up till now, it was Trump was saying we're having talks with China. China was saying absolutely, we haven't had any talks yet. There'll be no official talks. But now, you know, we've actually had some talks, which is good to see. So hopefully there will be some kind of resolution. Trade talks. I can see if I can find the headline. But yeah, it's going to take place in Geneva this weekend. Tariffs. If I can find the headline. Geneva, maybe. Geneva's Kitchen of the World. Trade talks. Here we go. And there's a nice picture of, is that Geneva? No. There we are. So this is the article. So Scott Bessent's going to be sent to talk to Chinese counterparts in Switzerland, and that's going to happen this weekend. So that's lined up. So it's good to see that they are finally talking, because it's crazy for both sides to have this trade war. But being crazy doesn't seem to be an issue at the moment. Next question, last question, importantly, is from No Strings. Says, great channel and ever so helpful. I've started a stocks and shares ISA and invest engine with Spider MSCI Acqui. Should I drip feed or just move the 20k in? If drip, how quickly, slowly? Yeah, there is no right answer for that, I don't think. This is No Strings asking the question. I don't think there is a right answer. Usually people drip feed over a period of about 12 months. It really depends on how long you can be bothered to do it. It is a pain rather than just allocating the money. But look, if you're the kind of person who, if you allocated it all today and it fell 10% tomorrow, if that would really eat you up, if you'd lose sleep over that, well, drip feed, because it minimises regret. If you're the kind of person who's quite happy to take the risk, if it falls 10%, you don't care, well, just lump sum it, you know. And there is no right answer for the period. Just remember that equity markets tend to drift upwards over time. So it becomes more likely the longer you leave it that you'll leave some return on the table. So just don't do it for too long. Accelerate it if markets do crash. That's really important. But don't slow it down if markets rise. You know, that's not going to be good. You know, don't kind of draw it out over a longer and longer period. So only, you know, at most, say, if you decide on a 12-month drip feed, you'll be fully invested in whatever allocation you want by the end of the period, guaranteed. The only thing you can do is accelerate it. That's a really important discipline, because remember, the goal is to become fully invested in whatever you choose. So just be really disciplined about it. The way I do it is to have a calendar reminder to tell me move this much from cash into, or money markets, into this fund or funds which you choose. And every month I just religiously do that. Whatever is happening in markets, you know, I completely. The only thing I pay attention to whether markets have crashed. If they have crashed further, then I accelerate it. That's the goal. So let's cut it there. Thank you for joining us, and thank you for your super chats. Don't forget, many happy returns. Definitely have a listen to that. Don't forget our website membership, for our premium website membership, pensioncraft.com/membership, if you want to learn more about that. And we also have a free weekly market roundup, which we publish on a Friday, which is humorous and talks about whatever's going on in macro and in markets. So if you want that, go to pensioncraft.com/newsletter. Very easy. And thank you for joining us, and good luck with the portfolios. And we'll be here again tomorrow night at a much earlier time of 6 o'clock. So please do join us to hear what the Bank of England's doing. So thank you for joining us, and we'll speak again tomorrow.